Hello, everybody, and thank you for tuning in to the Liberty Report. With me today is Daniel McAdams. Daniel, good to see you.
Good morning, Dr. Paul.
Good. There was an interesting story floating around in the last day or so about Bill Gross, who's been known as the guru, the king of the bonds, and he proved he really was, because he was a bull on bonds for 4 decades. And as long as interest rates were going down, he was betting on it, he was long on them, and as long as the rates go down, the price goes up, and you can make a lot of money, and they did, and he operated a PIMCO fund. But then a couple of years ago, there was the investors weren't quite as generous, and they were challenging him. He was still doing well, but there was a little disagreement, and he was sort of forced out of PIMCO, the company he started, so he went over to the Janus Bond Fund. But he still has a very strong reputation, and he's still dealing in billions of dollars. But his announcement just in the last day or two was that the whole system is at risk. I mean, it's a big deal. He's changing his opinion about what to do with stocks and bonds. And the day of reckoning, he used those words, is at hand, which means there's going to be big changes. Well, there's big changes in the way he's investing. He's not long on bonds anymore. He's not buying stocks. So he's probably in the mood now to short bonds, or at least be very cautious. And I think that this could have a lot of significance, because even though he is the guru, I don't think he has a total control and comprehension on what the politicians will do or what the markets will do. But he's somebody we shouldn't ignore.
And this is from an article we saw today in the daily, in the Zero Hedge, about Bill Gross. And he recognizes some of the problems that you've discussed a lot of time, but he has a slightly different view of what should be done.
Yeah, and he's predicting confidently, which would fit his investments, that the Fed will raise interest rates in June. Well, right now, they always do statistics. Well, 1/3 of the people think that either he's going to, and 2/3 not. The stocks haven't been doing too badly, so the stock market hasn't anticipated, a raise in interest rates in June and some more later on in the year. But sort of that's what he's betting on, that will happen. And if that is the case, stocks will be a bad place to be. Now, my big question would be, how can you depend on that? I've always argued that it's going to be devastating, to the stock market when they raise these rates. But his argument is that right now, especially in the last 6-8 months, although the market's held up pretty well, nobody's making a lot of money. A lot of big money is leaving the market, so therefore they're very hesitant. So I would say that I still question a little bit about his timing, the politics of it all, and whether they will get a Federal Reserve Board chairman right now to raise interest rates under these conditions.
And he points out one of the main reasons why he's changed his view on it is that the stimulus from central banks worldwide, he says, has artificially pushed up the value of stocks and credit. So it makes him feel more cautious. It's a bubble, I guess.
Right, and there's more to it. The interest rates are key. That's the biggest issue. I've been talking about interest rates for a long time. But there's other things that they can do. They have a President's Working Group on Financial Markets called the Plunge Protection Team, which I believe they interfere in gold as well. And these all have an effect on perception. So what will they do? Right now, the system has been designed to keep the stocks up. Just tinkering with interest rates has been successful in keeping stocks up, and Wall Street's been very happy with this. But the big thing, is he right? What is the timing? The one thing is I've been concerned, and he is now concerned, although he is not an Austrian, because he says there's no inflation, and therefore they can raise interest rates and all. I think because I define inflation as increase in money supply, tremendous inflation of the money, all going into the stock market and into bonds. So he made a lot of money off inflation because it inflated the bond prices artificially. But his timing might be the key to it, because right now he's throwing in the towel. He just doesn't think this system works. He doesn't want to give up on the system. He says that the system's sort of okay. We just need a different management. He even says, maybe a Paul Volcker could solve all our problems. I sort of challenge him on that.
Well, you've spoken, very positively about Volcker as being probably the best Fed chairman we've had. How would you differ if he says we need another? Is it the circumstances changed?
Well, as much as well as I got along with Volcker, and he was a little bit more straightforward, he was a little bit more sympathetic, and he recognized what I was talking about. But Paul Volcker, he kept things together, but he's managing a system that I believe is unmanageable, and that's why we get to this point. So when you have that happens, good temporary management actually increases the bubble. I think where Bill Gross probably excelled was the conventional wisdom, when Greenspan was in, that there was a need for a recession and, the market was going too fast, but he never raised interest rates. And he stuck with the bonds. He believed they're not going to raise interest rates, where over the last 30 years or so, they'd always raise interest rates and calm the markets down. So he went along with that and timed it the same way with Bernanke. He said, Bernanke will keep it going, keep the market going. So he kept making money on this. Then all of a sudden now, though, and this is why I think this is interesting, is he no longer thinks that type of tinkering is going to work. Although he says the tinkering that is necessary is for the Fed to give up on that, and that if they do this gradually, a little in June, a little bit more on, it's going to work. See, I don't believe that. I don't think he's really getting to the real issue. He recognizes bonds, and when there's too much money in there, the prices are too high and the stocks are too high and all these things. But there's a lot more to the malinvestment and the debt bubble that exists that's disseminated throughout our whole system. Housing bubbles and NASDAQ bubbles and education bubbles and all these things. So there's been such dislocation that a smart Fed chairman might be able to hold the stock market together. And in a way, in 08 and 09, they did achieve that. It didn't fall apart and we have a new system, but we still face a major crisis. But once again, the big issue here is somebody who understands the conventional wisdom of central banking is all of a sudden saying, it's not working anymore. And then he also brings up the subject of Japan.
Yeah, that's what I was going to ask you about, because that's interesting. It seems in a way that Japan is sort of us a few years down the road, and it's the way we're continuing. And he points out for Japan that it's going to be simply an issue of the central bank acquiring the debt and foregoing repayment. He says, this is interesting, he says, I think that's where Japan's headed. I'm not endorsing it. I think at some point Japan will basically buy up all its debt and the central bank will forgive the treasury and try to move forward with that. I see no other way out. Is that the future for us as well?
Yeah, probably. It's not first choice, but I think if his predictions are right, it will, go through all the central banks. But the default, the liquidation will occur, even though policy doesn't do it. Eventually people just give up on it, and there's a default through just inflation. That is like if there are pension funds they can't pay and they don't have the money, or Social Security. If you get $1,000 a month, they're not going to default, but the money will be worth a lot less. So there is a default by devaluing. But what he's talking about is a default in just stiffen them, stiff the government, stick the treasury. And yes, I think that could be, but boy, doing that with a reserve currency of the world, where confidence factor is the whole thing. There's no logic behind trusting the Fed printing trillions and trillions of dollars for that to last forever. So when they start tinkering with defaults, if they can default against our treasury, why can't they default against you and I, who are in an insurance company or something, and we hold treasury bills? Oh no, we're not going to pay you. I mean, that would be the end of the dollar system. So I would think conditions would get much worse if Japan goes through with this and they start suggesting that other central banks will. I think conditions would get so shaky that they would probably be forced into coming up with something better. But I don't think the answer is going to be what Bill Gross is betting on right now, that June is going to usher in a new policy where there's gradual escalation. That fits the argument of the Fed chairman I've visited with over the years. And they said, yeah, we agree with these things that you need to be doing. But as long as it's done orderly, if you have to devalue the dollar, do it orderly. But eventually it becomes disorderly, and that's what I think Gross is hinting to. He's concerned about this day of reckoning, and it's going to be major, but I guess I lean in the direction of thinking it's going to be more major than he is, because maybe he thinks if he can just adjust his investments, and say, now I go long on debt, and I can figure this all out. I say, I don't know what the plunge protection team is going to do. I don't even know what they're going to do politically. I don't know what they're going to do, on the gold market. And people are going to be, really confused. It's going to be chaotic. Of course, that's why I resort to believing in gold, because though they manipulate, I'm sure, they've done it for many, many years, there's more value in holding gold than holding these treasury bills that are either going to be devalued, and you can't get your money back that's worth the same, or they won't even give you your money back. I mean, and that could happen rapidly. So I think they're going to be very, very cautious that the United States doesn't look like that. They're getting ready to that. Even if Japan does it, I don't think it's going to be magic for Japan. They should have 20 years ago just allowed, the natural forces of liquidation and bankruptcies and get that all away. Get rid of the malinvestment. Get rid of the debt. I believe they'd be back in economic growth again if they could reestablish confidence. Say, this is the yen. This is how we're going to do it, and we're not going to inflate. Of course, in the past, what they would do is convey confidence that the dollar is related to a commodity and take it out of the hands of the politicians. But ultimately, the solution, I think, to this will be the elimination, well, of course, getting rid of central banking, but reducing their power and authority and getting rid of this obsessive belief that they know something about what proper interest rates should be. And now that we've done this for 40 years, and we have survived it so far, although there's no middle class left, and the government's way too big because it is inflated too. They can't solve all those problems, and I think the people are going to wake up and just doing this. I think you have to not only audit the Federal Reserve, you got to get rid of the Federal Reserve, and you have to allow, if you only could do one thing, is just say, look, nobody's saving, there's no economic growth, we want to return to normalcy, nobody wants to get rid of the Fed. Just have Congress take away the power of the Fed to manipulate interest rates. It would be a big deal. There's no doubt about it, because Wall Street would hate it, because every day they wake up and look and they're betting, will the Fed raise interest rates or won't raise interest rates? And right now, Gross is betting they're going to raise interest rates. And if people come around to agreeing with him, the stock market is going to go down, but the stock market could go down just because it's inflated too. But the market eventually will raise interest rates. Let's say the Fed does everything conceivable, prints money like they've been doing, and buying up all this debt. Eventually, if the market, and especially foreigners, give up the idea of buying our dollar, and they can't, and nobody will borrow our, pay for our debt and buy our debt, interest rates will have to go up. I don't think they can eliminate, but right now everybody trusts that the Fed's in charge, they control it. And now, even a 0.25% interest rate rise is a big deal, and we're not going to do it. But it is a mess. There is a day of reckoning. I think we are approaching it, and I really respect Gross for his efforts and opinion. I just have some disagreements on how this might evolve, and the fact that he's not too excited about Austrian economics.
I think you may agree with him with one thing, which is interesting. He says the era of central bank dominance is almost over.
Well, yeah, this is great. So, but in the meantime, do this. I think he's right, and he's, I guess, hoping. He may feel stronger about that than I know. I've never had a conversation with him, but right now that is his opinion. But the whole system, he's talking about the market and all, but he used the word the whole system. the whole system is at risk. The economic system and everything depends on the value of the dollar because it holds things together. It pays for our runaway spending and our debt that we run out. It takes care of the welfare beneficiaries that need and want and demand things. And it also takes care of the warmongers, the people in the military-industrial complex. And even in Congress right now, they're oblivious to this because they talk, oh yeah, we have to cut. But you know, there is a collusion between Republicans and Democrats about how they spend money. Even in all this argument and bickering and fighting going on, when anything happens in Congress, there's usually behind the scenes an agreement that spending will go up. Nobody in Congress is really saying, you know, we ought to really cut this. There's no sincere attempt to do this. They're just hoping and praying that the Fed's going to take care of them. And that's, of course, how we got here because it worked rather well. It built the welfare state, and everybody seemed to benefit by it. The warmongers got their weapons. The people who wanted to be on welfare, and now we have 40% or millions of people on food stamps. Well, the day of reckoning is here. It's not only in the bond market, in the financial markets, the day of reckoning for our whole economy is here. And that's why we ought to be prepared to present at least an alternative to this. And of course, for me, the alternative is free market economics and no central banking, sound money, and a basic principle by the people to understand what the role of government ought to be. And the role of government ought to be to protect our liberties, not to run our lives and not to manage the economy and not to police the world. Believe me, we could do that without a central bank and somebody trying to manipulate the interest rates. I want to thank everybody for tuning in today to the Liberty Report. Please come back soon.